Welcome to the ETF Show, taped here at the Asset TV studios in New York. I'm your host, Kristen Myers, ETF Editor-in-Chief for Asset TV. Option income ETFs are now on the rise. A recent analysis found that flows into derivative income ETF have outpaced traditional dividend ETFs in recent years. And when looking at equity-specific strategies, the derivative income category has exploded, growing to more than $150 billion by January 2026. To discuss, we're now joined by Will Rhind, founder and CEO of GraniteShares. Will, thank you so much for joining us today.
Thank you, Kristen. Great to be on the show.
So, Will, I just read you that stat. I'm curious to know why you think that income ETFs have become such a dominant trend in the ETF space lately. Now, is it because of, rate uncertainty? Is it because of inflation? Is it because of risk, or is it something else entirely?
I think it's because, up until very recently, of course, the narrative was very much that interest rates were on the way down, and therefore people looking to preserve a higher level of income that they perhaps got used to enjoying over the last couple of years. So with the current Fed chair on his way out and a new Fed chair coming in later this year, I think expectations are still in place that interest rates will fall this year, and therefore people are looking for income and looking for ways to generate that in the portfolio.
Now, GraniteShares has a whole suite of yield boost ETFs. Can you explain a little bit the strategy that's behind those products? How are they really generating income?
So Yield Boost is in the category of options-based income ETFs. And put simply, these are ETF income strategies that generate high levels of income using options to do that. Now, Yield Boost is a little bit different in the sense that these are funds that pay a weekly distribution as opposed to monthly or perhaps quarterly. But the unique aspect about Yield Boost is you'll see some of the highest yields in the market, and those are generated through options.
Now, given the current climate that we have, the US-Iran war is still ongoing. Oil prices are elevated, although they are sliding as of recently. How do you really find that this type of environment is impacting demand, for these income-generating ETFs?
I think that it will very much depend on people's view of the war. In other words, if people view it as something short term or something more protracted. But I think what we can say is that demand for income is constant, and demand for income is growing, particularly amongst not just retirees, but investors who increasingly are looking to generate a standalone income portfolio out with, say, their primary source of income, which is typically their job. And so we see this big movement online and elsewhere to create income portfolios. And I think regardless of market environment, that will remain constant.
Now, I want to talk about one of the critiques, really, about some of these income strategies, and that's really going to be the cap on the upside. A lot of investors worry about sacrificing too many gains. So I'm curious to know really how you sort of, balance that income generation with the capital appreciation.
Yeah, I think first and foremost, people have to understand that when they're buying a covered call ETF, when they're buying a put right ETF, or indeed some of the autocallable ETFs, that they're income products first and foremost. In other words, their primary goal is to generate income and consistent income. And so these are not products that are high growth. And therefore, the trade-off is that you're trading away some of that growth for income. So if you're looking for a high growth investment, then options-based income or income strategies are not the right place to look. However, if you're looking for high levels of income, then absolutely, whether it's yield boost or autocallable style ETFs, options-based strategies are certainly something to consider.
So you just mentioned, right, autocallable ETFs. GraniteShares has a full suite of autocallables. Now, a lot of investors know those really as, structured notes that are offered by the bank. So curious to know why you wanted to put that strategy inside of the ETF wrapper. Is there something about the wrapper that you really feel like gives an advantage over the structured note from the bank?
I think the first thing to talk about is that, like a lot of the best ETF strategies in the market. They take something that already exists, put them into the ETF wrapper, and make them even better. So the 2 points that instantly improve on the structured note would be lower fees and liquidity. When you buy a structured note, typically it's fine or it's not a problem to buy a product. But if you want to sell it back before the maturity date, that can be troublesome. And a lot of these notes don't have a secondary market. Of course, ETFs, that's the primary selling point, is liquidity, and there's a two-sided market throughout the exchange trading hours. So I think those 2 points really illustrate the benefit of housing something like that in the ETF wrapper. And I think when you go on to talk about the other benefits, you're going to see things like diversification through the ETF wrapper by buying a portfolio of autocallables as opposed to speculating just on one.
One of the other, advantages that a lot of people mention about ETFs is actually going to be transparency, right? And this is obviously a more complex strategy, right? That it's going to exist inside of, the ETF wrapper. What do you make of that kind of tension there, right? Between these really increasingly complex strategies that are going inside of the ETF wrapper. And do you think that the wrapper itself offers perhaps any advantage in terms of that complexity that is inside of that strategy?
Absolutely. I mean, again, this is core to the ETF philosophy, core to the benefits that people enjoy. And what they love about ETFs is that the transparency is there. That's a regulated construct. And autocallables are no different. You can see the portfolio. And issuers such as GraniteShares, we publish the details of that on a website on a daily basis so people can look at the autocallables that we own in the fund, and they can look at all of the different barriers that are at play versus the stock price itself. And so it's really, again, taking transparency to a new level that you just don't get with a lot of other structures.
What types of investors or really even portfolios do you think these products are really best suited for?
Well, the structured note market in general and autocallables, which are, if not the most popular strategy within the structured note world, are certainly among the most popular. These are principally financial advisors that are buying these and using them for clients. So the market for autocallables is very much financial advisors and ultra high net worth individuals. So we don't expect that that will change by putting that into the ETF wrapper. It'll still be most likely converting existing users into the ETF wrapper themselves. But broadly speaking, we still expect that to be a financial advisor driven audience.
So I want to talk about leveraged and inverse ETFs because that's something that a lot of people know GraniteShares for. How are you seeing demand for those products really evolving?
I mean, demand is huge, and particularly in times like this, where you get a lot of volatility in the market, you get a lot of movement in stock prices. And of course, our leveraged and inverse offering consists primarily of levered and inverse exposures to individual companies or single stocks. And right now, this is an environment where we see single stocks trading up and or down a lot given the volatility in the market. So a lot of the tech names, industrial names, etc., there's a lot of movement. And for people that are short term in their outlook and are looking to play this volatility, we see a lot of interest in leveraged ETFs. So typically in this kind of environment, we see our volumes increase in environments like this.
Yeah, would you describe it really as more tactical trading activity that you're seeing really in these leveraged ETFs lately? Because, I mean, volatility, I think, is almost the theme of 2026.
Oh, in an environment like this, absolutely. I mean, there's no doubt that there's a spectrum. I mean, clearly we trade somewhere in the region of $3 billion a day on the GraniteShares platform. So there's a huge amount of money being traded. And therefore, there is a spectrum, of course, of buyers. But I would say that the majority of those people are absolutely tactically trading, maybe not second by second, but certainly day by day, given the events that are rapidly unfolding, of course, all the time.
I have to ask about a question that has really been, I think, come up a lot this year and even last year, which is right, the 60/40 portfolio, traditional fixed income and its place inside of portfolios. and really how income ETFs are now coming along, right? So I'm curious to know if you see these, income ETFs as serving as a sort of complement for traditional fixed income inside of portfolios, or do you see them actually more as a replacement?
I think they can be both, and there's no sort of right or wrong answer. I mean, they're a complement in the sense that options based income doesn't allow you or doesn't mean that you're doubling down on traditional fixed income risks, i.e., credit risk or duration risk. So, from that perspective, it's not correlated and therefore can be a good complement. It can also be a replacement because of that, because some people that are in the fixed income world don't want to expose themselves to those risks or want to minimize those risks, and therefore will look to something like options based income or alternative income strategies as a replacement to some of the traditional fixed income. So I think it can be both, just depending on what kind of portfolio you run, and of course what your financial objectives and goals are.
What do you think advisors are, really still misunderstanding about income ETFs?
I think that something like autocallables is not so much a misunderstanding, but we're in the early stages. I mean, GraniteShares just launched the first ever autocallable ETFs on single stocks for advisors who understand or who use existing structured notes. There will be a little bit of education required in terms of understanding the benefits of the ETF wrapper. But I think it's very much like where Buffett ETFs were before they really took off, where they took that strategy that was prominent within the structured product world, wrapped that in an ETF and created a new market. So I think that that's where we are today with autocallables. And to the extent that there's any misunderstanding, I think that it's at the moment just an education game where people are getting used to a new category of ETF and something that they already use in a new structure.
All right, so I'm going to ask you to pull out your crystal ball for just a second. Looking out ahead to the rest of 2026, I'm curious to know where you're really seeing some of the biggest opportunity inside of specifically the income space in the sort of ETF universe.
I think that the autocallable space has massive potential. That's where I think we're going to see significant interest for this year and beyond. And again, that's only because this is already a massive category within the structured note world. I think what ETFs do is take that recipe and make it even better. And so, from that perspective, we expect to see a lot more demand for autocallables, and that will probably be the product of the year from an income perspective.
Product of the year. What great closing words. Will Rhind, founder and CEO of GraniteShares, thank you so much for joining us today.
Thank you so much for having me. It's been a pleasure.
And thank you for tuning in to the ETF Show.